Welcome everyone. Welcome to this webinar on the crazy times we're in these days. So we are calling it From Bubble to What, and we're calling it making somewhat of a sense, as much as we can, of what's happening in the current market. I am Andreas. I guess many of you know me as the founder of EUVC, together with David as always. But David this time will be joining us from our expert panel, leaving all the hard work of managing this conversation to me. I hope we will be able to get through it. As I said, this is a session on, what is going to happen, what is it that has happened. That's what we're going to dive into a bit. But before we do so, I would ask just Dan Polanka from Affinity to tell us a bit about the report that you've written and kind of give us some context to everything here. I'll pull you up, Dan, so now everyone will be looking at your face, waiting for you to tell us some exciting things about the new unicorn report that you've put out on the state of VC in EU versus the US.
Great, absolutely. Thanks for having me, Andreas. So as you mentioned, I'm Dan Polanka. I'm a senior product marketing manager with Affinity. For those of you who aren't familiar, we're a platform built to essentially empower deal makers in relationship-driven industries to find, manage, and close more deals. So we work with a large number of investors across private capital and the investment banking space. And through that, we're able to understand sort of trends that occur within those spaces. So for this report, we specifically looked at, sort of VCs that are investing in unicorns across the US and Europe, and understanding both the growth rate of those different unicorns and how our investors within the platform are growing their networks, growing their deals and opportunities and things like that.
Super cool, Dan. And now I'll ask you, Orla, to just tell us a bit about the data set that you've been working on together with the Affinity team for this report. Would you give us some insights? Where the hell does this come from?
Yeah, sure. So Dealroom is an intelligence platform for discovering the world's most promising startups and startup ecosystems. That's what we call ourselves. But basically, we track startups and venture capital deals globally. So we're based out of Amsterdam, but we have global coverage, having kind of started with a focus on Europe, but now it's very much global. And this report kind of looks into what's been happening in the last, year, basically, in venture capital, and what's happening with unicorn rates, and what's happening in Europe versus the US. Like, how has the kind of downturn and pullback been manifesting itself differently in different regions? So yeah, we can kind of talk a little bit more in detail about the data as we go through the report, maybe.
That is beautiful, Ola. And I think that just before anyone thinks that this is a good role for Ola and Dan to be in, I promise you, I'm sure our expert panel will be putting them to the test on anything in this report that seems the least bit off or not in tune with what they usually see. So I am very excited to see what's happening in this webinar, and the same thing goes for you in our audience. If you have any questions, do pop them in the comment section. We get them all here live, so we can pull them in. And as Morten Helgeland asks, is there still some background music on? And yes, there is. I can turn it off like that, and then I can turn it back on if I feel like amping up the vibe here. But now let's jump right into it and look at the first chart. And Dan, I'll call on you to tell us exactly what are we looking at here.
Great. So essentially what we're looking at is the quarterly rate of unicorn creation from 2020 to around September of 2022. across the US and Europe. And so what we're seeing is the US held, a higher ground in terms of pure unicorn count, as to be expected. But, we are seeing that Europe has actually been outpacing the US in terms of growth rate. So through Dealroom's data, we're seeing, an average growth rate of around 2x year over year for the past 5 years within Europe, compared to around a 52% growth rate for the US in terms of new unicorns.
And I am curious to hear, because we're looking at somewhat the same developments here, though much larger scale for the United States. But Dan, what were your reflections when you first saw this?
Yeah, some of the curious things for me were the big spike that we did see in Q3 of 2020. Some of those numbers could be attributed to pandemic related growth, so industries that would have possibly benefited or been able to grow within that environment. And like you said, it does look like a similar trend, but in terms of just the numbers when you get down to it, obviously Europe is coming from a smaller starting point, so the growth rate of 2x is a little bit easier to hit than it would be in the US. But yeah, I would say that it is interesting to see that we are seeing investors sort of flow into European markets at this time.
So I know Anne Lee really wants to comment on this, and Anne Lee, I'll give you the chance to do so. But first, I'll put Dan on the spot here, just because many of the people that we have joining here has probably heard Dan and I talk quite a bit on the EUVC lowdown about what the hell is going to happen in the coming years, and this graph, of course, absolutely leaves us all thinking, well, what will happen after Q2 2022? So give me just your mumbo jumbo on that, and then I'll let Anne Lee come with something much more informed.
I would love to give you my jumble or whatever you call me. Well, I'm kind of intrigued by the data. I mean, I always, whenever I look at the US European differentials, I'm always kind of intrigued by the fact that 50% or so of American unicorn founders are immigrants. They're not American. Well, Americans. I'm doing an air quote in my little booth, and I'm also kind of wondering what was originated. I don't know if anyone has any data on this, but what was originated in Europe or other areas, but listed on the Nasdaq. And then I'm thinking, where is the SPAC effect in this graph? Maybe that was part of the group. So there are all these kind of, before we get into the future piece, there are all these kind of backstory pieces. I mean, until we have somewhere for European founders to list in Europe, how are we ever not going to be so American centric? Because all we're going to do is build companies all over the world, go to the States, the land of milk and honey, and then list on the Nasdaq, and then off we go. And so I don't know to start with. Is anybody?
Actually, we can kick that to Orla, because I think Orla can answer to whether this is actually measured as where they have listed, or where they're headquartered, or where they were founded to begin with. Could you tell us a bit, Orla?
Yeah, so this data, so we have all of that basically, but this data is looking at HQ. So I just had a quick look on our platform. There are 66 US HQ'd unicorns that were founded in Europe. So those are ones that maybe founded in London, or maybe in Warsaw, and then moved to the US and subsequently reached unicorn status. That doesn't capture the kind of the whole immigrant founder picture, because ones that were founded in the US and HQ'd kind of always there, then they would just count as a kind of domestic US unicorn. But that's certainly an element of, and a decent chunk of the US unicorns. It's something that we see more in smaller emerging ecosystems as well. So for example, we just did a report on Central and Eastern Europe, and another on Southeastern Europe. A large proportion of their unicorns, particularly that kind of from 5 years ago or so, ended up moving to either the UK or the US. We're now starting to see a generation of startups that are more likely to stay at home and scale. And you see that as an ecosystem grows, there's kind of more capacity to host those unicorns. But there's, of course, the US is still always going to be a bit of a draw.
Yeah. So, Anli, now I'll kick it to you. Tell us, what do you have to say about this beautiful chart that we're looking at?
Well, I'm not sure if that's more insightful than that's already been said to start with. I think, but I think what's really interesting about this graph is, I think when you're looking at sort of growth within these sort of large companies as well, when you look at what they did sort of pre-pandemic versus what they did during the pandemic, and if you now look at the numbers again, all these big companies have now regressed to the numbers that they had pre-pandemic, while at the same time have been sort of, I guess, over hiring for this sort of growth movement, which of course that's why we're seeing a lot of these tech layoffs now in the market, also in the US, and I'm sure coming in Europe as well, in some of these very large companies. But I think that also sort of relates to how many of these unicorns that we will see today. I think there are some really promising companies out there now that have missed sort of the unicorn mark, or the ability to raise at such a valuation, even though they could have in the past. Also because sort of investor sentiment has slowed down, or at least cooled down, I should say, so much.
It's definitely something that we often hear, and people commenting on, saying, well, I guess how many of these are actually still unicorns? Or is that something you've looked into at all?
Yes, it's tricky. Obviously, if you have a declared down round or something, then you can say, okay, they're not a unicorn anymore. But often these things aren't necessarily published. But it's something that we, yes, try to keep an eye on, because it's a growing trend. Yeah, you could, even with the drop off here that you can see on the chart. I mean, 2020 was a time of kind of 2 unicorns a day that were being created. Those times are completely over. And yeah, some of the ones that have the label might start losing it as well.
Yeah. Then Dan is asking us something here on the chat, which is, how many of these unicorns are, debt model unicorns, or the stuff SPAC driven? Dan, would you expand on what you're saying in our little private chat here?
Yeah, I'm having a little moment in my I'm in a hot box, and I'm in one of these soundproof booths, and it's really, really hot, and I'm just getting grumpy old man agitated. So I'm wondering, how many were SPAC driven? How many of those unicorns are SPAC driven? And I'm also wondering how much in this kind of very frothy, tourist-driven investment scene that we've seen for the last 2, 3, 4 years, how many of those unicorns are what I call dead model unicorns? I'm not sure it's bloody obvious, but how many are actually have got a viable profit-making model, as opposed to just the tourist cash and the VC all piling on top of each other on this kind of never greater fool theory of investment? I'm wondering how many of those unicorns are real potential, not necessarily, but I guess they have to be at this stage. How many are real profit-making businesses?
Orla, I am guessing that this goes beyond. Such an analysis would go beyond what you usually look into.
No, I'm actually trying to do it in real time. In 2020 and 21, there were 50 of those unicorns were SPAC driven. That's just in the US. And
what was that proportionally, Orla? What's that proportional to the amount of unicorns?
It's less than 10%.
Oh, okay, so it's not impactful. Okay.
No.
That's cool. And Andrea Diaz says, I'll put it up here so we all see it. Andrea Diaz says, love that question from Dan. So Matt, props Dan for being the one asking the awful questions. Now let's get to the next slide, which I've been looking forward to. And I know that Enes and Marvin are going to want to jump on. I think it's not from the report, but I wanted to bring it in because this chart to me shows, a lot about capital efficiency. We're of course looking at how European unicorns are doing more with less capital compared to the United States. And I'm calling on Marvin on this because you're investing both in US deals and you're US based, but you're also very much with Diaspora Ventures investing into European deals. So Marvin, I'd love to hear your first reaction both on seeing this chart, but that's just a chart underpinning what the reality that we all know. So I just ask you to tell us a bit about your own investment thesis around this and why you believe that Europe is actually very interesting in contrast to the US, and how capital efficiency plays into that.
Yeah, no, it's actually, I agree with this chart, right? Everything I see in the portfolio where I think the cost structure in the US, people are just way more expensive. Everything's just way more expensive in the US in general. And so, I'm a big believer in, our thesis at Diaspora is finding sort of like pre-seed founders who want to come over to the US market. So looking for folks like lots of awesome talent, just do they have the mindset and aggression levels to come to the US to compete? And they do. The ones who do come out, they do very, very well. And so I think the chart rings with me. I think valuations tend to be a little bit more, tend to be better, right? Slightly lower in Europe. Not that that's a big sort of like, sort of rationale for investing in Europe, but just the technical talent. I think you're seeing a lot of like cross-border teams, right? Sales and marketing in the US and keeping sort of like the back office and technical talent somewhere in Europe, right? Which technical talent in Europe is fantastic. And so looking at these charts, just to make a comment on the previous chart about sort of the spike in unicorns, I think a lot of it was also not just necessarily driven by SPACs, but I think a lot of it was there's just so much more capital in the US. So we have a crap ton of hedge funds and we have a crap ton of private equity firms. And, I think you can thank like Tiger and Cotu and Viking and SoftBank Vision Fund for a lot of that garbage and that spike, right?
Yeah, I think so too. So Enes, I want to give you the chance to also comment on what Marvin just did in returns of capital efficiency, because that's of course the underpinning of emerging Europe very much.
Yes, I think capital efficiency in and of itself is I think a bit vague and irrelevant, because when you compare any region in the world to the US, obviously you see a chart like this, whether that's Africa, Latam, Southeast Asia, Europe, when you're comparing to a place where there's the biggest competition for talent and obviously the largest number of tech companies, then any other company or country or region is going to be much more capital efficient. I think what's more interesting is how that capital efficiency correlates to access to talent and talent retention, and then how that becomes a competitive edge for a lot of these European unicorns, because the talent competition is much lower, which is also why they're much more capital efficient and the cost base is obviously lower. That also means they can access better talent, and more importantly than accessing that talent, what's important is to be able to retain that talent for not 2 years but 5 years or 10 years, which is very important. And what we do here at 500 Emerging Europe is assuming that talent is cheaper, easier to access, and easier to retain. We have the leverage to be way too early into a market. We don't have to time the market. We don't have to be too scared that we're a bit too early to the market. We can be 3 years, 5 years, even 10 years early into the market, as long as we know we can sustain in the market. Once the market is mature enough, our companies are going to be much well positioned. So I think like this is what this graph shows to me and kind of validates our thesis behind the fund. Secondarily, on a separate note, comparing emerging Europe to the US, because a lot of these emerging European unicorns do compete with US giants in the US, it almost builds an anti-fragility, because a lot of our companies here from emerging Europe had much better business dynamics, healthier unit economics, healthier payback periods, etc. But the market wasn't valuing that. The market was valuing hyper growth above everything else. But now that everything changed and market wants profitability, gross margins, etc., it almost turned in a way that's positive for companies from emerging Europe, because while their US competitors were burning tens of millions of dollars on a monthly basis and were years away from profitability, our companies are always 6 months to a year away from profitability. So I think they're going to be the ones to survive this.
I mean, I hate to agree with Enes, but I actually do agree with most of this. I actually saw this really great quote on Twitter. I think is very, very relevant. This guy, Dare Obasanjo, he said, we're going to look back at a generation of successful founders and with the realization that all of their talent was in creating a bull market. Their tactics and advice clearly makes no sense in today's world.
Yeah, absolutely. So Augustine, you have, you're the French guy here. You're the U.S. French guy. Give us your perspective. You are doing much the same as you're focusing on Paris-based or France-based startups and then taking them to the U.S. I'd love to hear more about what this chart makes you reflect on.
Sure. And when I see this chart, it makes me think we're on a good track with our own VC investment thesis. But I'll rebound what Marvin and Enes just said. When I see this as, Europe is a good place to start your business. Europe is a good place for an entrepreneur to come and start your business. You guys have mentioned tons of good arguments. And I do think If we want to link this chart to the chart prior, that European startups need to think a lot more like Israelis or Dutch or Nordic countries do, which is leverage the engineering base in Europe, but try to market and sell your product in the US. I think the main reason, and it goes back to a question earlier by Dan, like where are these companies from initially? But I'm sure Europe would have a lot more startups if we stopped thinking, France is enough, or Germany is enough, or England is enough to build a unicorn, but rather we need to target Europe as a whole. Or our thesis, which is a bit of a contrarian thesis, is whether you're German, British, France, Italian, Spain based, your next natural market should be the US. And then obviously your capital efficiency might go down, but that makes sense. Keep your engineering pool in Europe and then try to build your sales marketing team in the US. And I think we'll get a lot more unicorns. And then a lot of what we say is start in France, develop in the US, and then come back to Germany, England, Spain, Italy, etc., and all the other countries. That's what I see when I see this graph.
I'm curious. I love the rest of the VC panel here to jump in on that one. Is that a good strategy? Is that what you would say, Dan? I know you invest with Superseed in founders that come from mainland Europe, move to the UK, and then oftentimes they of course move also to the States, but not necessarily. How do you think about this moving from the east to the west, and whether that's the approach?
It's still the land of sunshine and glory. I mean, you have 360 million people, one country. I know it's not, it's 50 countries mushed together in one, which is in Europe. You have, this, even though you have this regulatory framework in the EU, you still have, multi languages. But I think there's the other macro angle, which is that, well, I was having this debate with one of our founding team members the other day. It's like, well, what is a London startup? They might have a London address, but tech teams in Pakistan and Croatia and CEOs in Manchester and the sales teams in New York. I mean, what is an American startup? I mean, they're there once at a certain size to go and grow into scale, into list. But what is a London startup? What is a New York startup? I think I come back to my original point. And until European founders have somewhere to list in Europe, that draw will not happen. And until we unlock pension fund capital and other sources of capital, that draw will not unlock. So even though my strategy with Superseed is we invest across Europe, we bring them to the UK, we polish them up, brand network cash, and then take them to the States. I don't want to do that. I want to service up. No offense to Dan and any other American listeners. I want to service Europe. I want the UK and Europe is UK Europe? I'm not sure anymore. I want us collectively as Europe to be center of the universe. There's no need to do this anymore. So I kind of want to stop that brain drain. We have the talent, we have the skills, we have the access. We just need to think a little larger and a little more bold.
But it's a good point. But unless we have that capital, that's why we're saying to if we are a European company and the entrepreneur says, I have this disruptive technology, unfortunately, if they stay in Europe, it's just gonna be that much harder to develop and win that market. And so we're telling them, go to the US to leverage that market. In France, we have public retirement, we don't have private pension funds, and that's a huge problem. So I agree with you. I do think at the moment, going to the US to leverage those financial capital market is the best way to create European unicorns. But
I can't agree with you more. I mean, you're absolutely bang on. It just doesn't have to be this way. It doesn't. I mean, it won't be.
It's unfortunate. Correct.
You guys are the same
clear.
stuff.
It's not just the capital markets. It's also customers, right? If you're B2B,
sure.
You're going to go to US customers. That's actually the adoption in Europe of enterprise, like Fortune 500 enterprise of technology, is like super low.
Yeah,
it's not going to get any
better. And also the point that Dan touched upon earlier is that in truth, Europe is still relatively fragmented, right? So that doesn't play at all to our advantage either. Like moving into other markets, adjacent markets, whether in the European Union or not, it's different. It's not one big country like the US. So it's not only financial markets, it's that too.
And just from a B2B perspective, because I think a lot of our portfolios are much more B2B, and the success stories that we're talking about are also B2B. From an enterprise software perspective, US market is larger than the rest of the world combined. So let alone France, let alone UK, like you combine 200 countries in terms of enterprise software budget, and US still is larger than all of them combined. So it makes a lot of sense. Just one thing that Augustine did, I think, at least from a thesis perspective, what we try to do is we feel either companies need to be US born so that they do the right customer discovery with enough early adapters, because obviously there are much more early adapters in any category in the US compared to, unfortunately, Europe. So we feel that either they should be US born or they should target the US after they become a unicorn. I don't believe in between. I don't believe in companies conquering France, becoming Series A, B, or conquering, I don't know, any market in Europe and then targeting the US. I think if you're in a red ocean market, that's something you do after you mature your product, after you have a lot of resources, and then you try the US, or you build the product for the US from the start. So I have a more of a binary approach there.
I deliberately didn't say anything because I wanted to see if you, Augustine, wanted to say anything to that directly. Do you, or shall I continue?
No, I mean it's different. What we observe basically is we used to invest in these French startups. Again, we're Paris based. We have an office in Palo Alto, just to give you a little context, but I won't spend too much time on us. And if the startup stayed in France, eventually it would die out. They would leave the VC route, or if the company would go straight to the UK, British are just doing business in French people, and so typically London became the cemetery of a French seed startup trying to expand to Series A. And once we started seeing some success with French startups who moved to the US, and I think that's where we've developed some sort of a thesis. So I'm not saying you're wrong. I'm just saying, I mean, you're not wrong. I mean, we're look, our job, we're 80% of the time we're wrong. So we've seen some success there, and so we're really trying. So what we did is we opened an office in the US, and so we're really trying to specialize in this one line between Paris and Palo Alto. That's my answer. Quick.
So now I wanted, because you actually, Dan, gave me the perfect segue here, but that's about 7 or so minutes ago. But I really wanted us to take us into this chart, which shows, the investments in European unicorn and where that money came from. And looking at this, I thought it was incredibly interesting to see how big of a chunk the US investors are in our unicorns. And that is, of course, back to we need pension funds, we need more investors in Europe, we need more capital in Europe, and our markets aren't as good as the US ones. And I think this chart shows it very clearly, that it's very, very interesting that the European firms don't put as much money into the startups that end up actually being the greatest successes of our continent. Orla, do you have any commentary to the data set behind this, or Dan, do you want to comment on this?
Yeah, I mean, I think it's probably not that surprising to people here. Like the old adage goes that seed is local, Series A is regional, and beyond that, you're looking internationally to raise. So there's more capital, more dry powder in the US, and as you get to later stage, then more money starts coming in from the US and indeed Asia into European startups.
Yeah, taking us back to what we spoke about before with how many of them actually came to be public in the US. We're still looking here, at a chart that shows the money piled in also from the time at which they go public. So that means that, I guess, public money or from an IPO in the States would count on this towards being US money.
That's not actually included here. So this is just looking at kind of venture capital, private investments. But yeah.
That is interesting. Do anyone care to comment? Because otherwise I'll show you the same chart, but for the US unicorns.
I have one question, totally out
Yes.
of the blue. It has no relation relative to this chart. A lot of the unicorns are billion-dollar companies, right? So companies don't become $5 billion and they're unicorns, so that they become a billion-dollar company and become a unicorn. What I mean is companies who are going to be valued at 800, 900 become valued at 1. And I think if we had that data, I would say 80% of the unicorns are $1 billion, not more than that, which is weird. Which means with the current downturn, I would say 70 to 80% of these companies are not unicorns anymore. So my question is, are you tracking any of the secondary sales in different secondary platforms like equities, etc., to see if these companies are still unicorns? Because that graph would be even, I mean, when you look at new unicorns per quarter, obviously it's getting, I mean, there's a churn, there's a lower new unicorns, but I think there's also churn, a big churn. And I think maybe the total number of active unicorns would be 50% of what it is 3 quarters ago. If you were to track.
We do correct on which companies are no longer unicorns, but this chart was just showing kind of investment. So so of
but
that,
do you track secondaries as well? Because there are more frequent secondaries than primaries.
We track some secondaries, yes, but probably an area we can track more.
Yeah.
That would be a fun graph.
As much as you can track. I just wanted to bring up this one and show you then this chart showing the investments in the U.S. unicorns, and then just saying obviously here U.S. capital reigns supreme. I don't think that surprises many. Let's go to the next one, which is the most, let me call it like this, the most discussed chart on LinkedIn, at least on my LinkedIn. And that's a chart mapping out the unicorns throughout Europe. We now have 409, and we have them coming from more than 80 cities. I would love to, ask the panel here, how does this chart make you think about, the path forward for Europe, and how can we, build a stronger ecosystem when this is what we need to cater to, a hugely fragmented market?
I hate this graph. Why isn't Turkey here?
Turkey is right down here to the right of the white stuff.
Exactly.
So Orla,
why isn't Turkey here, man?
Orla,
because you have zero, because you have no unicorns, man.
I think we have actually updated this map since.
They do.
We have more unicorns than Spain, Italy, obviously.
Yeah,
in Turkish lira. Yeah, in Turkish lira, man. Measured in Turkish lira, Enes.
There's also one in like northern Finland that's been cut off as well. So we might get some complaints from them.
I'm boycotting this part of the conversation.
And I will now highlight you, and I will ask you to give us the sales pitch of why is Turkey actually part of Europe, and why are we all neglecting it when we forget to put you on maps like this?
Bro, geographically, Turkey is Europe, right? I mean, Turkey is obviously Europe. Historically, Turkey is Europe. Economically, imports, exports, Turkey is Europe. Tax, customs, no customs tax for a while. It's been 3 decades, I guess. Turkey is Europe. From a constitution perspective, equal rights, blah, 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 Turkey is Europe. Turkey is a part of the European alliance, one of the first members of NATO, and still Turkey is not on this graph. So I don't know what else Turkey should do to be on this graph. I guess the whole country should convert to a new religion, and then they would be included in this graph, right?
I had to give you the spotlight, Enes, for this. I've promised you many times to be able to give that speech on air. So here it was. Thank you, Enes, for that. Dan, I would love to hear, what are your reflections when you look at this and see how dispersed the unicorns in Europe are?
Which Dan? Is that me, Dan, or Dan Affinity?
That's you, Dan. Yes, sorry, Dan.
Yeah, I mean, I'm a bit of a broken record. I want Europe, including Turkey, Enes. I want Europe to be on the map in a massive way. I think obviously everything needs context. I mean, if you've got dots here for like a unicorn here and a unicorn there, I'd put that in almost like the not the luck bucket, because I'll be punched in the face. But I mean, it's great that there's stuff going on in Europe, but we're still, 409 since the beginning of time. I mean, what's America per year? I mean, so we've still got and obviously China and the rest of the world, we've still got so much to catch up on. And London is still the center of that universe. I think Andreas, are we going to come on to the actual top unicorn city slides?
No, we are actually not, but you have it here. So you've got the top unicorns, meaning the top unicorn cities. Is that what you mean?
Yeah. So I can't. Sorry, it's a bit small on my screen, but I think there's.
So we've got the green dots here are showing 20 plus unicorns. We've got Paris, London, Amsterdam, Berlin, and Stockholm showing with that, and then we have a bunch of 6 to 10 unicorn cities or ecosystems just around London, and same thing in the Amsterdam, Germany area, and then if anyone cares to see it in detail, we have more in the in the report, of course. But I'll also shift to this one. We'll come back to and this one as well. But we can see. Let me just see here. We've got a bit here on this on the development of the main nations, where we've got the United Kingdom, of course, going strong, stronger than anyone else in Europe, and then we've got Germany catching up a lot in the last 2 years, and then we've got Sweden, France, and Netherlands as the next three ones. But obviously, there is a big divide between the UK and Germany versus the other countries that we have in Europe.
But this has got to be correlated. I mean, I think I'm right in saying there's 4 times more capital flowing through the UK than there is through the entire list combined, or the rest of the list combined. So there's got to be correlation again with the American. There's the capital, there's the access, there's the smart people. So I think the UK is next in line, but we just need to. I think the unlock piece here is unlocking that capital flow and that home to then own all of the recycling. So we're not sodding off to the States to go and list. So we've got to kind of attack it from all angles, really. But I think it all starts with the capital flow.
Yeah, and if we just go back to that US Europe comparison, if we look at this map, we're seeing that we've got 170 unicorn cities with one or more unicorn, of which 65 are in Europe. So Orla, this is your chart. I maybe ask you to take us through, how you've been thinking about this and also the data that you used to compile it.
Yeah, so I mean, the cities that we count are any city that's produced at least one unicorn, and I think it's really interesting that Europe has actually got more cities that are home to at least one than in the US. There's a much greater kind of concentration in a few big hubs in the US. I think that you can look at that in different ways. It could be seen as a really interesting opportunity if you kind of are able to create some of the connections between some of those hubs. You saw the concentration of the number of different cities in UK, Paris, and surrounding area, and in the Netherlands. Within there, you've got kind of Oxford, Cambridge, Manchester, not far away, all these interesting kind of science and innovation hubs with a huge amount of potential. And I think that one of the things maybe we could do better in Europe is not really thinking about those borders so much. Like, these are realistically pretty close to each other, a lot of these cities, particularly if you were to think about them in kind of North American terms. And sometimes we think about it as being a long way to go from London to Amsterdam, but actually it's 4 hours on the train. So yeah, I think kind of a lot of different ways you could interpret this, but I think you can see it as an opportunity for sure.
I think I saw Dan writing Brexit in caps in our chat. But Anne-Lee, I also saw you nodding a bit there when we talked about borders, or when Orla said we need to not think so much about borders in Europe. Would you care to comment?
Yeah, I think the thing is, Europe is so different in the US in so many ways. I mean, not only that is because it's geographically one country, but also every country has its own culture, I would say customs, definitely language, its own sort of like laws and regulations. And so there's definitely a lot of difference from one country to the other. So yeah, that's the only point that I wanted to point out here.
Yeah. And I now wanted to show you this chart, which we skirted just before, but does reply a bit to what Dan said. Are we going to look at the cities? It's super small, sorry for that, those of you who don't have your glasses on or a huge ass screen. But as you see, the US, we've got 392 of the unicorns coming from the Bay Area, and then 113 from New York. And then we're getting very quickly down the list with 61 from the greater Boston region, and then Los Angeles with 54. And then we're down to the 28s and 21s and so on. And then when we look over on the green one, which is Europe, we've got 71 in London, and then Paris and Berlin, Stockholm, Amsterdam, Munich are all there with going from 21 down to 11, and then the rest of Europe with 115. So what this chart tells me is the rest is a much more important bucket to be thinking about in Europe, and that's why I think I'll actually kick this one to David to talk a bit about how we as fund investors think about getting exposure across Europe.
Now, I've been thoroughly enjoying listening in, so I've been a bit quiet on purpose. So thank you, everyone. But that's that's absolutely it, Andreas. When you kind of took my own words, I was looking at it and I was thinking, it's the only region where the rest is bigger than the biggest city of that region, right? And it's really interesting. I think it's one of the most beautiful things about Europe and one of the biggest opportunities in Europe. And us as LP investors at the funds, it's basically a core underlying fact of our strategy. So I find it super exciting. Yeah, it's challenging, of course, and Annalie kind of talked a bit about it, and definitely there's huge challenges. But I think it's a beautiful opportunity that how can we turn that, the challenging of us being so dispersed or condensed around specific cities, how can we turn that into an opportunity? And I think that's why UVC does what it does, right? That's why we strongly see that as an opportunity.
So now, Dan, I will call on you to give us some, introduction to the chart that I'll pull up now, which is a bit of the network intelligence that you're building inside Affinity. I was intrigued the first time I saw your unicorn report and this part of it in particular, because the other types of data sets we've seen before, but I think that this is something that I'm very keen on seeing where will this go to in the future, because I think it really holds some potential. So tell us what are we looking at, and be thorough with the data and how you work on it.
Yeah, absolutely. So, what we're seeing here are network growth trends from Affinity's VC customers who have invested in at least one unicorn, as that's sort of the data set that we were looking for this report to understand trends and behaviors within that space. And so, as of this September, Affinity now has insights on over 10 million people within our platform. And we provide our customers with, enriched data sets on their own connections, along with relationship intelligence insights that help them nurture and expand their networks. And through that, we're able to understand those behaviors a little bit better. So in this chart, what we're seeing is essentially we discovered that in Q1 of 2022, US VCs grew their networks by around 39%, while European firms showed a 22% growth. And then Europe showed a bit of a slowdown from there. Our data essentially here goes to around September of this year. And we saw Europe, at about a 4% growth at that point in time, and the US sort of continuing on, which in our, sort of analysis, we thought could be due to Europe sort of focusing on converting those contacts from Q1 into deals over being focused on expanding their networks at that time. Whereas the US, possibly, with more economic fears, was looking to really continue to grow those networks as much as possible. So they were set up for success when things do get a little bit better.
I've got a question, Dan, because Europe is considerably lower on this chart than the US, but it's per firm. So you can't really say that. Well, it makes sense because the US is a bigger ecosystem. I guess that's not the story behind it. Is it because are you only tracking other Affinity clients, and Affinity is bigger in the US? So for that reason, the US comes out on top here, or what's the explanation behind that big, huge divide?
Yeah, that could be a big part of it. Obviously, we are looking, to grow within the European markets, and as being a US company, we have a lot more data on those types of customers. So I would say that as we continue to expand through Europe, these numbers might start to pair up a little bit further. But just looking at sheer growth within those firms, we're seeing that the numbers are higher within the US.
And that means that I can translate this into meaning that a US investor on average has a much larger exposure in their network than the rest of, or than what we have in Europe. Is that what you're saying?
Yeah, I would say that, and a big part of that might be due to the fact that, for at least, and maybe the panel might disagree with this, but people do tend to work a little bit within their borders first when it comes to, working on their network. So within the US, there is just a much larger network to grow within your own region. And then when you do start to go cross borders, then you are going to see a bit of a slowdown there, as a lot of people are going to prefer to work with an investor within their own region.
Yeah, interesting. I'll kick us to the next chart and ask you to dive into this one, which shows deal opportunities per firm. Tell us, Dan, what are we looking at?
Yeah, again, so outside of strengthening networks, our customers are able to run analytics, and they have tools that help them manage their opportunities and pipelines. And again, through that, we can understand the behaviors and trends across a wide set of VCs. So, in this case, what we're seeing is the U.S. had an 8% decrease in new opportunities from Q1 heading into Q2 of 22. Europe, along that same time, had a strong increase of around 23% quarter over quarter in Q1, and then followed by around a 31% decrease in new opportunities, most likely due to a combination of focusing on those deals that they had brought in the previous quarter, and then, of course, heading into sort of the summer vacation period as well.
I guess, Europeans do more vacation in summers is also one of the things that there's a big dip in summers in Europe, less of a dip in the US.
Yeah, that's right. We never treat ourselves to long vacations.
So there's a bit of truth to the memes that go around saying that Europe is on vacation, and that's the auto reply that you get. Sorry, I'm on vacation. I'll get back to you in 7 days or something like that. Whereas a U.S. investor will say, sorry, I am at the dentist. I will be with you just the second that he puts down the scalpel, and I'll then, before he starts inserting the new tooth, reply to you. So please hold on for 5 minutes, and I'll get back to you. Marvin, you're an investor on both sides of the pond. Tell us, is there some truth to that statement? I know that we've talked a bit about.
Yeah, we've had that conversation. I just think
we were maybe a bit drunk, but we do remember.
Yeah, no, that was a long night, fun night. But anyways, I think it's true. I mean, we just the joke is just like you work all the time, right? And so I'm based in San Francisco, and just like everyone just works, right? It's like San Francisco is the Las Vegas of work because it's just competitive. That's what you have to do for the business, right? And so I do think we work a lot more. I don't think it's better. I don't know if we work more efficiently, but we just work a lot more.
Yeah, I do have to say that there is some truth to that. I would say also, Marvin, what time is it on your end, just to give you some credit?
Well, I'm in the Middle East. So this isn't that bad.
That's good. I'm happy to hear that. I'm happy to hear that we didn't get you up too early for this. So this is actually marking the end of our run through of our slideshow, but I would love to ask everyone at the panel to tell me, when you have looked at these charts and seen Europe versus US, tell me just in one sentence, each of you, where do you see us headed? And then after that, I'll kick it to Dan to round us off. But everyone, tell us, where do you see the US versus Europe headed in the coming time, and why do you think that investor sentiment, and this is a tough one maybe, why do you think investor sentiment seems to be worse in the US versus Europe? Who will kick us off on that one?
I mean, I don't know if you allow us only one sentence on our outlook for the next year. I think
I'll allow you as many sentences as you want.
I think I can say one thing. I think it's going to be a tough year to come for a lot of the unicorns that were unicorns either in the earlier quarters or the ones that were hoping for unicorn status in the coming year. I mean, we're already seeing it in the market, and a lot of that is reflected in the public markets. Investors are no longer willing to put money after companies that are just growing. I think today, to grow 20% and have a clear path to profitability, or actually to be profitable, is so much more attractive to investors than 100% growth and no profitability. And absolutely, this will also, reflect in how many unicorns we will see in the coming year for sure. So,
and just if I can, Go for it, Ennis.
No, go, Augustine.
If I can jump in on this quickly, the one advice we're giving to our startups is, if there's one thing this Russian aggression on Ukraine is reshuffling the world, we think one of the big winners, because of their energetic and industrial independence, is going to be the United States. And as a result, who are the companies that are going to buy startups in the future? Are American companies. And so it just goes back to our initial beginning of the conversation. If we're betting on European unicorn, build them in the U.S. Again, I'm super biased, but I think the news events is showing us that the ones that are going to have money in a few years are more likely than the Americans than the Europeans. So that's my that would be my conclusion. That's the thing we share with every single startups that we've invested in.
And I totally agree with that. I think from a lot of different perspectives, if you look into the turnover of the largest companies and how tech companies became the largest in the US as opposed to Europe, where it's much more static, the turnover is not there. This is also individual, by the way. I mean, there was a stat, I'm making numbers up, but it was something like this, where 50% of the US population becomes top 10% for at least 5 years in their lives. Whereas the same number for Europe was like 20%. Only the 20% of the population gets to top 10% at some point in their lives, which shows how big of a turnover there is in terms of wealth in US versus Europe. And like in all of the discussions around 1% versus the 99%, I think as long as there's enough turnover on the 1%, it's not a bad thing. It drives the economy. Whenever it's much more static, like the case it is in Europe, then that 1 to 99% is a big problem. And unfortunately, I think you can only beat US by playing the US game, which again ties back to what Augustine says. I think emerging Europe, because all the unicorns and companies from emerging Europe are targeting the US, so their revenue is from the US, their financing is from the US, down the line M&A or IPO is in the US. It's just so that they leverage the talent back at home, so they leverage the advantages back at home, but while hedging against all of the disadvantages that comes with emerging Europe, I think is the only way you can beat US, which is what Israel has been doing, has a much higher per capita unicorn than the US. What Estonia has been doing has a much higher per capita unicorn than the US. So can Poland have a per capita higher unicorn number than the US? For sure. Can Turkey have one? For sure. Can France have one? Can Germany have one? As long as the companies are targeting local markets, no way.
Very interesting. Very interesting. Marvin, will you comment on this?
Yeah. One of the things I will say is just like US is grim. It's looking really grim. I think next year is going to be really, really tough in general. So what happens is US is always the first, right? Like they lay off people the fastest. They move the quickest because it's the scariest place, right? Like, and also we have the social policies or lack of social policies that allow businesses to basically fire people very quickly. So we make the changes very, very quick. Having said that, a lot of these companies are still sitting on a lot of money, right? So there's still a lot of VC money. There's still a lot of like all the FANGs have a crap ton of cash. There's going to be a lot of M&A next year, going into next year. I think next year will be pretty rough. I think it will come back in Q4. My guess is like Q4 of like next year. But I expect like Q4 this year is going to be pretty grim. I think Q1, Q2 next year is going to be pretty grim in the US in general. And what you'll see, at least last couple sort of like downturns, Europe lags like 1 or 2 years typically, right? Like just in trends and things like that. And so, yeah, it's gonna be tough in the US, but I do think we'll be the first to go into it. We'll be also the first to come out of it.
Yeah. And now, Mr. Dan, tell us what are your final remarks to the
man, I have so many thoughts buzzing around my head. And I think first up, I hope that we're going to now focus on stuff that's important and not faster grocery deliveries and e-scooters and all that bullshit. I hope those days are behind us. I think crypto is the only ugly, low-hanging fruit still to be regulated into insignificance, and I can't wait for that day. I want to see more money in the earlier stages. I imagine most investors will revert to type. I can see a lot of the growth guys moving into public markets, which I think is I'd love to see their LP conversations and have a little fly on the wall in their email inbox. I'm bull or bear. I love business automation and efficiency and productivity plays, and I think it's our time in the sun as a fund. I will always look for the flip. I will always look for the opportunity. I think that we're going to see much more values-driven VC. I think there are so many niche players coming in, focusing on very specific things that are going to improve society. And I think that's going to be more of a trend. And I want to lean into that. I want to see much more, I know it's a bullshit phrase, but democratization of VC. I want to see more automation of VC, more access across the board. And I really, 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 really hope that Europe, however we do it, is more on the map, and we continue to take a chunk out of the US and become more American, if you like.
Orla, take us out of this Americanization of Europe, please.
Oh, well, I mean, I agree with a lot of what people have said so far. I think it's obviously going to be a tough couple of years, but we're certainly long on startups and innovation, and we're long on Europe. And I think that Europe has the next wave of really big companies, I think, is going to be coming from deep tech, and Europe is really well positioned to capitalize there with incredible universities and talent pool, if it can be kind of translated through into businesses that are supported and scaled. I would also add, there's a lot of fear out there, but there's also a lot of capital still around. So VCs have raised more capital this year than any other year. The year's not over yet, but there is a lot of dry powder out there. I think people will maybe be take a little bit longer over deals. We're seeing that already. But I would agree with Dan that there's some other elements such as impact focus or diversity aspects of investment thesis that are going to start coming in as well. And I think maybe that's no bad thing as well.
For sure not. David, I have to give you the mic to say some final remarks on what Orla just said, because I think that she said some things that very much are aligned with our thinking.
Absolutely. I'd also say something along the lines of looking at unicorns is looking at part of the whole landscape, right? There's other data that I am personally super excited about that we have, that Europe seems to be delivering better returns than the US, and that is very exciting, right? And that is not necessarily connected or disconnected from the unicorn conversation, but it's a different way to look at similar dynamics, and that really excites me. And I think that is really insightful for all Europeans. And to take a bit of what Marvin was saying, I think the beautiful thing about Europe as well, I don't think we'll go as low as the US, but we'll never go as high either. But I think that is also interesting. And yes, Andreas, the niche plays really, really excite us, right, at the European VC. And I think that we're seeing more and more in Europe, and I'm super bullish on that. And I do believe that Southern and Eastern Europe will really be like super exciting areas to be investing in. And hopefully we can be a part of that, and some of the panelists here today as well. So really, really excited about the future. It will not be easy, but I'm an optimistic, so I'm very excited and looking forward to it, actually.
And now, Dan, take us out of here. Tell us your final remarks.
Yeah, absolutely. And I'm trying to tone down my Chicago accent with all this talk about Americanization. But I think, to Orla's point, the idea that there is a lot of dry powder out there and a lot of pressure to put that money out into the market, we're kind of going to see a bit of a game of chicken in regards to, when do valuations bottom out, and when does that money become vital to actually take at a lower rate? So to Marvin's point, I do expect that we will see some tougher times towards the beginning of the next year. From what I'm reading, we're going to see valuations sort of drop around or hit their low point around the halfway point through next year. And then it's just a matter of how long does it take for those to actually get to a point where they do become more attractive to those companies. So I guess we'll have to wait and see. And, I'll take this opportunity to also plug that we are predictions guide for 2023 at the end of this month, focused on how to prepare for 2023's markets and, adapt to those shifts and be competitive. So, if you do want to find out more about that, you can go to affinity.co, and hopefully there's some good insight for everybody here today.
That is beautiful. Thanks so much for ending us on that note, because I think that's the big question that all of us are, of course, pondering and trying to figure out how to navigate in what is going to happen in the years to come, or the months at least. So thanks a million, everyone, for joining us. We're so happy to always have your support in whatever we do. Dan, Anne-Lee, Orla, Enes, David, Augustine, and Marvin, thank you for bearing with me as your host for this, and thank you for sharing your insights with the community. Thanks so much, and see you all somewhat soon.